this thing is going to massively, drastically, significantly, exponentially increase your profitability. Crazy intro, I know, but let me get it straight. I'm going to get right into the video. What I mean, I increase my win rate by maybe 20%, 3% just by aligning the high time frame drawn liquidity with the lower time frame drawn liquidity. But first, we have to understand what is a drawn liquidity. A drawn liquidity is basically the closest liquidity pool to us. It could be fair value gap, swing low, swing high, equilibrium, any confluence, any liquidity based confluence. And is that place where is the market moving next towards to? Drawn liquidity can be hard time frame drawn liquidity, for example, a daily fair value gap, but it could also be like a short-term, lower time frame drawn liquidity. In this example, these would be the closest opposing liquidity pool in form of equal lows down here, because we just swept these equal highs, swept the liquidity above them, and the closest opposing liquidity pool, the next drawn liquidity, are those swing lows, those equal lows. Yeah. And you're gonna massively increase your win rate by aligning hard time frame drawn liquidity with the lower time frame drawn liquidity. Again, the same example. Let's say that on the daily we have an untapped daily fair value gap. You can see that we have swept the previous daily high. We taken out that liquidity, and on the daily time frame we want to move back down to rebalance to that daily fair value gap. So this low, this fair value gap is our drawn liquidity on the daily time frame. We have our bias for the day. That's good. Daily bias, good. Wow. But we can take it a step further with that lower time frame drawn liquidity alignment. So we zoom in. This could be like a 5-minute, maybe 15-minute or 3-minute time frame, and you see that whenever we have swept the previous daily high, these highs, we taken out that liquidity, and we have the daily fair value gap low, which is our target. But essentially, this is the closest opposing liquidity. So now the drawn liquidity, I mean, I've said so many times the liquidity word in this video, and I'm going to say it so much times, but you have to understand that this is the reason the market moves, and this is the most important reason the market moves. Back into that, we are going to sweep those equal lows first, even before sweeping this daily fair value gap. So with that in mind, we have our hard time frame draw liquidity defined, as well as our lower time frame draw, but we are waiting for entry model to occur, maybe some inverse fair value gap or something, yeah, like just here, and we would not be targeting all the way down here. Yeah, like this is relatively close, but let's say this would be more further down, yeah, like something like this, maybe even some low down here, yeah, like that. Even another social liquidity pool, we would not be targeting all the way down here, just because the market could sweep out this equal lows, then come back even lower, sweep this whole side, and then maybe revert, re-sweep that buy side. Yeah, like it's just too much volatility inside of that range. We are targeting so high risk-reward ratio, and on average, if you're gonna target a lower risk-reward ratio, you're gonna have a higher win rate by default, just because the market does not move 1% a day, 2% a day, 500 points a day. We are more likely to catch small 50-point, 73-point move within the market every single day, just because it's more probable to happen. Yeah, even on a no-news Monday, you can catch a 50-point move, but probably on a no-news Monday, it's not gonna happen that we're gonna have a 500-point sell-off, like 2% in a day. That's why lower win rate, not lower win rate, lower risk-reward ratio will get you higher win rate. And with this model, with the alignment of higher time frame drawn liquidity with the lower time frame drawn liquidity, you're gonna get that higher win rate. And meaning behind why taking that low ARR trade. Yeah, so back into that. We're waiting for the entry model, and we are targeting just those equal lows, because this would be so much of volatility to happen. Let's get into some real chart examples. I'm just gonna delete this so you can see that I'm not trying to go back and I don't know, a month ago. Let's see. What do we see? Yeah, let's plot the volume profile. I said you can use it with any confluence. We have this value area here. and we have this sell side liquidity down here, those unfilled fair value gaps down here. So this is my drawn liquidity on the 1 hour, 4 hour, even like the daily, or like the 1 hour time frame. We have our higher time frame drawn liquidity defined. Let's now zoom in and let's see what the market was doing. Okay, so we swept those, we had the manipulation, we sold off, we could have taken some photo trades towards that. Yeah, maybe some sell side. But let's say we missed that. What next happened? We have swept the sell side, moved back up, yeah, barely swept this low, which we created like relative equal lows down here. So we are more likely to sell off, but we move up. Okay, we got internal sweep over here, and this was our time to shine. This is our lower time frame drawn liquidity with that higher time frame drawn liquidity sitting below. Absolutely perfect bias, drawn liquidity, everything in line. Now we need to find an entry model. After we got a manipulation, sweeping the buy side, internal buy side liquidity, we got a massive displacement to the downside, inversing this 1 minute fair value gap. Even if you would not catch this entry from the 1 minute, but this would be actually a good entry, targeting that sell side, still change in state of delivery happened, and we could enter from that, even like the small fair value gap that happened, that occurred here. Yeah, with maybe a bit tighter stop loss. You can see the market sold off, swept at lower time from drawn liquidity. So we did not want to target all the way down here, just because it's not that it's less likely to play off. So we target just this internal liquidity, the drawn liquidity. Yeah, same with that example that I showed earlier in this video. The drawn liquidity is all the way down here, just fair value gaps. But before that, we have so much sell side liquidity that needs to be swept before actually tapping all the way down there to filling that higher time frame fair value. We have so many liquidity points, swing lows here, which we have to understand as resistance of the trade to actually break through them down. I mean, we eventually gonna break through them, but we are just catching small moves within the market, not big moves. Yeah, like this move happened in like, what is that? 1 hour, yeah, on the 5 minute time frame. This whole move might happen in like few days, maybe 1 to 2, maybe 3 days. We haven't even tapped that. Might even happen next week. What do I know? But yeah, you have to see that we rebalance 50% of that. We internally sweep that. Now we're probably gonna sweep this liquidity, maybe even break through that, break and retest all the way up here. And this would actually take us out. I mean, I'm not some Baba Vanga to tell you the future. That's why I'm not working like crazy risk to ratio, just small moves within market. And if you can take anything from this video, it's that. Target small moves, lower your risk to ratio, which will increase your win rate, and that increased win rate gonna give you smaller drawdown, and then decreased drawdown gonna let you to risk more, and then the risk more gonna get you to get even more money than with high risk to ratio. Yeah, and even like the amount of possible trade ideas during the day will increase because you're not targeting like a crazy move. I hope you get something from this video. Probably this is the most valuable video that I ever made. Yeah, like if I would delete every one of my videos, I would leave this on because like this is absolutely like a canon event. I got this idea on this video yesterday whenever I was trading, and I had a crazy realization that I need to make this and tell you this because like this is the most important thing. Draw on liquidity, aligning higher time frame with lower time frame drawn liquidity. So yeah, that's pretty much it. Scroll back through chart, see it happen, live trade it, backtest it, just see it happen, and you're gonna get profitable. Just do that. So yeah, thank you. See you on the next video. Peace out. See you.